do pledge and things like that? And
How do you? How do you?
We've been doing it.
They put a flag on the screen and people do the pledge.
Okay.
Okay.
You can, and under the circumstances, you can dispense with the pledge if you want.
All right. Well, I'm kind of a traditionalist. I like the pledge to start.
Oh, geez.
Are we waiting for? I mean, I'm guessing we don't have Ross yet.
No, we got Ross.
Yeah,
Oh, hi,
he's-
Ross.
Ross, is Amanda coming on too, or?
I'm here.
Oh,
Oh,
there you are.
Oh,
How are you?
Are we going to see Amanda for the first time?
The Brady Bunch.
There's Ross. Ross, I've seen you enough. Let's see Amanda.
Put a man on the screen.
That's not Amanda. Hi, Mark. Okay, and there's Mr. Shea. Nice to see you, Paul.
Nice to be seen and not viewed.
Yep. Hi, Kevin.
Hello.
Russ, I just want to mention, you could, I think Arnett set us up so we can all screen share.
Great.
I don't know whether you're more comfortable doing that from your end, or we could certainly direct her or me to, a particular page on the presentation if you want to show it up on the screen.
Yeah, I'll do it. My end will be great. I'm accustomed to it. Sort of have to
Fantastic.
drill down.
Yep.
And is Dawn there to take notes? or
yeah,
how
I'm
we-
here.
Oh, hi, Dawn.
Hi. How are you?
I'm great. You do a great job with those minutes. Thank you.
Oh, thank you. You always tell me that.
Well, and I always mean it very
I
sincerely.
appreciate it, but I couldn't do it without Jim
Mr.
and Ross.
Yes, well, that's good. Well, we appreciate your work there.
Thank you.
Okay, are we waiting for anybody else? Do we have a firefighter tonight? And I saw we have both of our police officers and we have our town council rep. And that would be the only, I'm not sure if we're gonna have a firefighter on tonight.
Yeah, we got
Yeah, we
Bob
do.
Shaligan.
Shaligan.
Oh, hello, Bob. How are you? Okay, so I guess we will start the meeting. Everybody ready to go?
Yes.
Yes, sir.
Sounds good.
Okay, so I will call the meeting to order. I'm traditionalist. I don't have to see a flag, so we can just recite the pledge. I pledge. Oh, there we
There we
go.
go.
Beautiful. I
Yeah.
pledge allegiance
Allegiance
to the flag of the United
United
States
States
of
of
America
America,
and to the
to the
republic
republic
for which it stands,
one nation,
under
under
God,
God, indivisible, with liberty and justice for all.
all. Okay.
Awesome.
Awesome. Good job. Okay. So we have, why doesn't everyone just for the record just say your name so that we'll all have that just for the roll call. Mike Evans, Chairman of the Retirement Board. Any order, doesn't matter.
Dennis Flagg.
Paul Shea,
Mark Izzo.
Steve Jester representing the PD.
Kevin Costa, PD.
Bob Shaligan, Fire Department.
Dawn Geit, Recording Secretary.
David Borer, Town Council Liaison.
Jim Jascott, Finance Director.
I see Gina.
And Arnett. And now we have Ross. Is Gina there?
She's there.
Oh, hi, Gina.
Can't hear her, but she's there.
Gina, is your mute on?
Don't know if she's muted.
No, she's
It's
not.
a show she's muted, but
Yeah.
sounds it.
Okay, and Arnett Talbot's on with us also. Has everyone had a chance to review the minutes from our November 4th meeting, the day after the election? Wednesday, November 4th. Has anyone had a chance to review those fine minutes by Dawn?
Yes.
Yes.
yes,
Any, they look great to me. I don't have any adjustments at all. Does anyone have anything to amend or to correct from those minutes?
No. Make a
Okay, I'll
motion to accept them.
Second.
Okay. Is there a second?
Izzo, second.
Okay, all in favor?
Aye.
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 Excellent. We were gonna do a review. We'll get right to the presentation on the investment update, which is obviously our main purpose here. I did notice in the email correspondence, and Ross and Jim, correct me if I'm off, that there is one final amendment being done to them, or legal review, or something to that effect. So do you want to just defer that to the next meeting?
Sure, I can
Or
maybe
just give us a summary.
Yeah, maybe just a quick summary. So just to take a step back, you may remember in the last meeting, what we had done is try to simplify a little bit. Each of the plans has its own investment policy statement. They are, almost identical to one another. The language is the same, with the exception of where maybe the allocation is different, maybe the actuarial estimates are different, but each was, I want to say, 15 pages. It's 60 pages. So what we did is a couple of things. One was to put them all into a single document, and also look to tighten up the language. So we had introduced that at the last meeting, said we were going to bring it back to this meeting. Hopefully everyone had a chance to look through it. And the suggestion that we're going to make here is not to go have a drafting session here, but to make sure that to the extent that you have an opportunity again to look through it, but before getting to the point where we say, hey, this is a final document. One of the things that we have internally is it's sort of like a little law firm, and they will scrub for all state, local, et cetera, statutes to make sure it's sort of like a free legal review, but to make sure that everything is in there is in compliance with all. And by the way, the documents that exist today, back when, and Jim certainly will remember, went through legal review, through town council as well. But we'll do that. But anyway, that's the high level, Michael, and I think it's important that, and I can field any questions if anyone has gone through them yet, but I think it would make sense not to approve them here, but to look at them and maybe look to approve at the next meeting with any changes, perhaps intra meeting that you may want to either send in. Maybe Jim would be able to fill that and send them our way.
So
Okay.
Ross, what we'll do then is, so then we'll get your legal folks will go through and do their scrub, and then we'll get the final version with a little bit of time to read through it just prior to the May meeting.
That's right.
Cool. Okay.
Okay.
Good
And then we'll just formally approve those. And I guess, David, you know this better than I do, then send those to the council for final approval. Is that the process?
That is the usual process. I don't know if it's changed in my intervening years out.
Okay, that's fine. That's fine. So why don't we do that? It is part of the package that, I don't know if everyone has the package or at least has it online. The 50-page package that Ross puts together. It's towards the back of that package, for those that haven't had a chance to review it in any great detail. So why don't we plan to just give it a quick review, not now, but prior to our May meeting. And as Mark recommended, and I concur, if there are any updates, which there probably won't be, but I understand the laws are always changing, so maybe they tweak something. If we could maybe get that by email prior to the May meeting, and then we'll do a formal, approval in the next meeting.
Yeah. I'll just add that, we generally review these documents once a year and approve whether, any changes are warranted. I don't think we've ever really gone back to the council for, their thoughts on it. This is, I don't know, to me, it's a policy regarding our, this board's decision on how they manage their investments. So that may be all we need to do is just to
Okay.
at this level. But we can
Okay.
certainly check with our attorney if he
Okay.
thinks otherwise.
And if
Okay.
it's not legally necessary, I'll just make sure to update the council as part of my report that you've been reviewing it and at the time that you adopt it.
Sounds good.
And again, Russ, we went from about, it's basically been summarized down to about 6 pages now, you said?
It is down to 6 pages, and I would consider it a sign of, and that includes a cover page. I would consider it a sign of success if, you all are able, read it and it's easy to understand. And the important areas are things that you can, for example, we put it in a table. You don't have to commit 60 pages
Right.
to memory. It needs to be usable. And I think that, just in looking at it, as Jim mentioned, in every November tends to be the meeting when we do that. And this past November, prompted us to, on our end to come back and just say, look, let's see if we can modernize this from where, we had done it a number of years ago.
No, that's perfect. Okay.
Good.
Anyone else have anything on that particular topic?
No.
So we'll go right to that exciting fourth quarter of 2020 investment performance.
Right.
And I also like the fact that, I think you might have done this for the last meeting, the additional column of since March of 2020. So I like that column as part of, so does everyone there have, oh, you're just going to put it on the screen. Okay, that's fine.
Yeah.
Perfect. Okay. All right. So Ross, it's yours.
So a few really the main points. I'm going to just focus at the high level, then maybe address questions. But the marketable portion of the main retirement plan, and for those who may not be familiar with that term, you'll see in the table most of the investments we have. We can update every day or update every month in terms of the value, but there's some illiquid investments where we call it non-marketable because we can't buy and sell it every day, but the values come in arrears. So we're just looking at the majority of the investments, which were up about 11.5% for the past 12 months, ending December. They're up a little bit more as of today from there. Not actually too much of a change, but a little bit higher. As mentioned, up nearly 31% since March 31st. At that point, the investments were down almost 15%. Global stocks were down about 21.5%. So there's been, considerable rebound, as you all, probably would have gathered. The past quarter, really the past 2 months of the year, almost an entire. In fact, it would have been a good year if it were just the past 2 months, really an entire 1 year return. And I would attribute it to, a number of things, but I think, sort of the main things. One is I would say sitting on our hands, letting the portfolio, just basically recapture returns from the early declines, particularly from some investments that at that point were, underperforming or maybe even underperforming our expectations. And then I think on the margin, there's some tilts in the portfolio. There's some small cap stocks which have done well. Credit in terms of the types of fixed income securities that have done well. Also, something we've talked about quite a bit, but lower duration. In other words, the portfolio's sensitivity to interest rates, as interest rates go up, if they were to go up, and that's been the case since the earlier part of the year, that would have a negative effect on the bond portion of the portfolio. So by having a lower duration, we have less interest rate sensitivity, and that's been helpful. And we have emerging markets, as I know we've talked about quite a bit, that has begun to do well. So those I think areas in the margin have been. In terms of just managers, and we'll get to them. There's just two that I would, in terms of attention. One is a fund called Oaktree Strategic Income. I mentioned the non-marketable part of the portfolio. Oaktree Strategic Income is one of the illiquid investments. It has a sort of a light to it, and it has begun to wind down. It's worked out quite well. And so it's begun to liquidate, and we'll see that money come out of that portfolio into the rest of the portfolio over the course of the next 12 to 18 months. And we'll get to this as we look at it, but PIMCO all asset, all authority. One suggestion that we have is it's existed in as you'll see in a part of the portfolio where we believe it belongs at this point just to reclassify it as alternatives, even though it has sort of a fixed income-ish type purpose. And so that's partly will allow us to do some rebalancing as we go. The investment policy we covered, and with that, I can maybe jump in a little bit and talk a bit about, give a little bit of the market backdrop, and then we can come and look at the portfolio if you think that makes sense.
Yes.
Perfect.
Are there any questions, by the way, about?
The only small comment I would make is, and I don't know, maybe it's a question for both you and Amanda. We always seem to show illiquids as zero, and I get it because they're slow. But is it possible to have current quarter just be last quarter? So we're just always kind of, you know what I'm saying? So we always show a performance, even if it doesn't match exactly to this performance. You know what I'm saying? Just so we get some kind of a feel. I know we have a chart that's on page 5 of 12 that does show, commitments and drawdowns and market value of that. But is it possible just, for my, financial advisor, CPA, like to see a number somewhere, even if we all know it's always a little bit late?
Yeah, there is. I'll show that to you. I'll be able to point that out. It's in there. It's and as you'll see, it's a bit of a hybrid number.
Okay, that's fine.
Yeah,
that's a small issue, but just in terms of it. Okay, perfect.
Okay.
So we'll go big picture, small picture.
So a couple things. One is, and I think I'm going to come back to some of these the highest level points, but I'll just maybe a little bit of a backdrop just in terms of last year. I think it's an understatement to say that it was an extraordinary year. Just to give a backdrop in terms of some of the things that took place. I mean, we saw what ultimately was the end of a very long economic cycle, longer than 10 years. The fastest ever bear market in terms, bear market is defined by the stock market going down by 20% or more. It went down faster than there's been plenty of them before, but this has been the fastest. We've seen the sharpest ever rise in the market, and more days with extraordinary volatility, and actually most of that was all within the first 4 months, then took place during the entire 3 years of the great financial crisis, or really any other measured period before then. You can see on the left-hand side of the page here, perhaps you can see the mouse, but I can also draw a bit, but you can see that for the most part, equities around the globe, different sectors, et cetera, with a few exceptions, ended at their highs. A few areas that were laggards, some of them have begun to pick up. And you can see on the right-hand side, just you just sort of add up the number of days where you had greater than 3 standard deviation changes in prices across stocks and bonds and commodities, just relative going back to 2003. One of the trends over the past few years, we can look back and say, well, geez, what a good year it was in the market. It will turn out to be when all said and done, earnings will decrease. Corporate earnings in the S&P will be down somewhere around 17%. So when we look at the S&P 500 and say it was a good year, it was up over 18%. The reality of it is that reflects the market investors' willingness to pay higher prices. The fundamental, stock returns and earnings, should over time, track one another. But we've been through now a number of years here where the market has just become more expensive for the same amount of earnings. In this case, I think markets are willing to look through this period and beyond, but nevertheless still willing to pay higher prices. And the same sort of phenomenon can be said about bonds. At the beginning of the year, or December 31 of 2019, or 1/1/20, the 10-year U.S. Treasury yielded 1.92, just under 2%. The total return, if you own a 10-year Treasury, was about 10%. How does that happen? Well, people bid up prices. What will happen? 9 years forward from the beginning of this year, people will look back at their 10-year return and they will have earned, approximately 1.92% in their treasuries, but 10% of that all came, at one point in time. So again, prices have been bid up, and you can see, where interest rates ended. They've come up a little bit from here. But just to give you to draw things back, when you buy stocks or you buy any asset, there has to be some, what is the price that you're paying per unit of, earnings in the case of stocks. And you can see that on a shorter term basis, the stocks, the S&P 500 in particular, which is the example that we're using, and I think it's really the most relevant, you can see is quite expensive. You have to go back. The higher this number is, the higher the price to earnings ratio. You have to go back to the late 90s to get anywhere near. Same thing, price to sales even higher. So on a 1 year, on a shorter term basis, markets are expensive. And another chart that we've looked at is something similar, but instead of looking at multiples on a 1 year basis, this is looking back over a 10-year basis. It's a little bit confusing because it's upside down, forgive us, because this is sort of a three-dimensional chart, but this dark blue line, as it goes lower, flip it around, it actually means higher. You can see, you can go back to, the late, you can go back to 08, you can go back to 1929, on a long-term basis, to the extent that you pay attention to longer-term valuations, it's also expensive. We think one should pay attention to earnings on a longer term, on multiples on a longer term basis. And one of the reasons, just to round this chart out, is that you can see this light blue line that tends to track it. And what this is showing is that the more expensive something is, right? So if the market is expensive on a 10-year basis, the 10-year return looking forward from any moment in time will tend to follow a similar pattern. So if markets are very expensive today on a 10-year basis, 10 years from now, it's likely that the return will be pretty low. If markets are inexpensive, you look at the big bottoms in markets, in March of 2009, for example, the net, the prices were very low, multiples were very low. The next 10 years, it turned out to be a higher than normal return. And this happens to be, I think, particular to the S&P, but you can see it in other areas around the globe. Markets have certainly become expensive. One thing and I think we may have spent a bit of time on this before, but our view last year, and we may have, I think we were a bit out on, perceived perhaps to be a bit out on the edge on this at the time, was that we would see a V-shaped economic recovery. But I want to explain one of the main reason why that was. It wasn't as if we were just sort of, trying to guess what would happen or putting our thumbs in the air. The big cue for us was the amount of, of monetary support, the Federal Reserve and central banks around the globe pumping money into markets, as they continued to fall, obviously very sharply, and the fiscal response, literally at this point, sending checks out in the form of either PPP, keeping businesses alive, supporting affected individuals and families through this period, putting money in people's pockets. And the size of that said to us, now this is not meant to be a long-term view, but it just said to us, hey, look, when you can sort of, in the short term, you can create GDP, because it's one of the government spending is part of that. And by putting money literally in people's pockets, that said to us that there would be, they would basically stoke an economic recovery. I think that view at this point is not that much out on the edge. I think it's probably a consensus view at this point. So I think that's probably more built into markets, but it does. But there are some implications behind it, for sure. And look, these charts, which I won't go over, just show you this is sort of the concept of the term helicopter money, which is an old Milton Friedman term, and then Bernanke. Their view was, in the case of Bernanke, if we ran into an existential crisis, if he had to, he would literally drop money from a helicopter. And that appears to be the case. I mean, you can just see, I just think it's interesting to give a sense of scale. This is, Federal Reserve's balance sheet would look similar, but just the amount of this would, I guess, represent money printing, but the size of the balance sheet of major central banks, you can just see 2009 was a major expansion. This would look huge if we stopped it right here. And you can see just the scale, how much more intervention there is in markets today. And of course, on the right-hand side, you can see, here's your V-shaped recovery in terms of, retail sales, consumers, spending. It happened obviously very quickly and got above by November, well above by November, where we started the year. You go back to the financial crisis, and yes, it was a recovery, but look, how long it took. So it's pretty dramatic what we've been through here. I think one other point, before we get into the performance, I think that one other thing to know about markets is that the last, particularly the last 3 or 4 years, but this has been going on for some time. You've heard us, and I'm sure in other investment discussions, how well growth stocks have done, and relative in particular to value stocks. What this chart is showing is an overlay of two things, and they may not seem on the surface related, but I think they are. That's why we overlay them. One is this dark blue line, which is really the underperformance of, this is the Russell 2000, so small cap stocks, relative to the NASDAQ 100, which is basically, let's use that as a proxy for, if you've heard of the FANG stocks, Facebook and Apple and Amazon and Netflix and Google. These stocks have just done terrifically well. Small cap companies, if you think about it, they're industrial companies, they're domestic, they're smokestack in many cases, not entirely, but that has really underperformed. Think about the technology companies that have done well, and many names that may not be represented here. Just think about the all of the work at home, even in recently that has taken place. Interest rates have come down for a long time. This is just over the past couple of years. Why are these related? Well, one of the reasons that they are related is that if you think about how you value a stock, it's just like how you value a bond. So I use that example all the way at the beginning, where you saw interest rates going from 1.92 to 0.92, but earn 10%, right? So as rates come down, the price goes up. Well, it's very much the same case if you think about stocks. Stocks are the market is basically taking future earnings, just like as if it were a coupon. It's not, but as if it were a coupon payment, and going as far out as possible and discounting it back. Well, the higher the growth and the further out that growth is, just like a longer term bond, the value of earnings way out in the future is very, very highly levered to what people are willing to pay for it. Again, just like a bond. Well, as rates have come down, one of the theories and one of the things I think has been the case is that when people model out, hey, what's this company worth, even if it doesn't earn any more money from one year to the next, the value of the future cash flows really goes up. Well, guess what happens if interest rates go up, as they have begun to do? I'm not necessarily we think that they will, but we want to have a margin of leave some room for for that not to occur. But nevertheless, we think that there is room for rates to rise. We think that they're artificially low. Well, guess what? Now it's not quite as valuable. And some of those nearer term earnings, the small cap companies or even mid cap, but the value type names, the ones that do well, maybe their earnings aren't as fast growing, but they become more valuable. And so that's one of the reasons when we talk about, the economy, I don't think we probably talk a lot about the economy. We may talk about earnings, valuations, and so forth. But when you get to these kinds of environments, the economy tends to be a very big inflection point. And that's one of the reasons also that our views, have begun to shift over the course of the past several months, that the areas of the market that would begin to do well, maybe would look a little bit more, for example, like a 99, 2000 type environment where the tech stocks got ahead of themselves and in fact did very poorly, but value value, particularly cyclical type companies, can do well. And of course, the portfolio is pretty well positioned in many respects for that. So before I jump in, I'm gonna just stop and pause right there and make sure that I respond to questions. Okay. So looking at the portfolio, what you'll see here, just again at a high level, is you can see I mentioned that over the past year, up a little over, not quite 11.5% on the marketable side. The illiquids, there is 0 for the quarter. You see a number since 320, since March of 2020. Although Amanda, if I'm not mistaken, I think all of these are now updated through September. So we don't know what the last quarter is. So it's as if the return is 0 for the past quarter. Amanda, right?
Yep, that's right.
Okay. So that's one of the reasons we don't spend too much. We always sort of backfill. And you can see where returns have come from. The traditional assets have done well. The alternative assets have done reasonably well. I don't want to make too much of short-term numbers. The longer-term numbers, the alternatives have all done well. And of course, you can see the bottom line of the portfolio is continue to grow. You look out over time, and and the further out you go, the numbers begin to get look a little bit more placid and even out in terms of consistency. Managers, I think generally speaking, managers have done well. Some have done actually particularly well. I will note that one thing that didn't make it into the materials, but there actually is another manager, not for tonight to deal with, but Ben Siegel, who's run this portfolio for a very long time, the Newberger International, decided his calling would be to go teach high school, and he's going to leave at some point here in the not too distant future. So we're going to have to address what to do, whether to maintain that portfolio or to move on. But you can see that some portfolios that were actually started, we had at the beginning of last year, Hamlin, who's a value manager, since their inception for the year was up a little over 5%. It shows up in the 1-year column. Value overall, was compared to, you can just see it's an amazing, again, we saw this last meeting, the Russell 1000 growth index was up 38.5%. The value index, up less than 3. It's two sides of the same coin. That's an enormous difference. It's rarely ever in the short term, but it's been that way for some time. Hamlin's done well relative to what it invests in. Clearbridge, up 33%, couldn't in 12 months manage to even beat the Russell 1000 growth. That's near impossible unless you're really concentrated. But they've been additive, and the other managers I think have done well. I think on the international side, I mentioned that we've had a little bit of a leaning, if I didn't, toward growth within international, and that's been helpful. I think Newberger is tilted that way as well. I'll come back to the IVA and so forth, and First Eagle. The emerging markets have done, did well last year, and certainly that helped. A lot of it, you can see, some of these numbers are remarkable off the bottom, up 52%. And GQG, again, our emerging markets active manager, but one that has more of a growth tilt. And you can see in the relatively brief period that they've been here, they have compounded. So when it says up 14.65, that's per year since 6/1 of 18. So they've done, that's a compounded number. So the cumulative numbers, is of course, quite a bit higher. But really, I would say overall, generally, pleased with managers. There's a couple here who, there always are going to be some that are not performing as well, and to some degree, I'm a little bit heartened by it, because if everything is doing well at once, I suppose it might indicate we're not doing a very good job of diversifying. So again, why don't I just want to be cognizant as I go, a little bit careful about pausing. Okay. To this point, by the way, on the illiquids, just to show where things stand, it's a nice page to take a quick look at here. We haven't made any commitments, by the way, recently to new illiquids, and we don't have anything at the moment to recommend. But if something compelling comes along, we certainly will. But you can see overall, there's 8 million worth of commitments. As those of you who are familiar know, when you make a commitment, that doesn't mean that you're invested in the fund. They do capital calls over a period of time. So there's been about a little over 7.5 million in terms of capital calls that we've sent checks in for. There's been almost 5.8 million worth of checks that have been sent back to us. They buy something, they sell it, they earn income, etc. And market value, as of you can see, well, it says valuation as of 12/31. That includes if there's been any money added to the 9/30 value, but it's really 9/30 values plus any cash flow. So you can see, if you add these two together, you would get a sense as to how much money was put in relative to what the value is between current and income that's come back. So it's turned out, to be a pretty good program, I think, overall in terms of putting illiquids into the portfolio. That's really it. We're going to do the investment. So we've done the investment policy. We don't have anything actionable today, other than I think that there's quite a bit on our radar that I mentioned. Of course, I mentioned the Neuberger Berman portfolio, which I think will be a subject of discussion at the next meeting.
Hey, Ross, I know it's a nit, but just go down to the bottom there, the fixed assets in PIMCO. So
which page?
Ross is on it. So the PIMCO, the all asset. So what happened there?
Meaning, why are they up so much?
Yeah, I mean, that's just crazy up compared to the benchmark, right? I mean, it's just wow.
Yeah. Well, a couple of things. One is that I mentioned at the beginning, we think that it makes sense at this point to reclassify it as in the alternatives bucket.
Right. Wow.
They do serve. The reason we have them in portfolios is because they have an inflation plus orientation. And if you think about fixed income, one of the downside risks is if you have inflation, right? If we were to have stopped the clock on PIMCO all asset, on 3/31, they would look horrific because we went through, this big drawdown. You go through, effectively the market prices in deflation. So a lot of what happened here, was just a snapback in their portfolio. They tend to have inflation. So we look at them relative to TIPS because TIPS are, inflation protected securities, but it's a very hard portfolio to benchmark because in reality, it's not as if it's a TIPS portfolio. It's one of the things that they look at because it's an indication. But inflation, as you can imagine, it's not easy to measure for sure. But anyhow, so we view it as a diversifier for fixed income, And for a long time, we've had it in fixed income, but it just creates a lot of brain damage, I think, in looking at it. And just as you point out, you're going to have it's all over the place.
Yeah. Okay, good. Thanks. I appreciate it. Just kind
But
of.
Ross, but we're staying with the same, are we staying with PIMCO all asset, all authority? Are we shifting it to another PIMCO all asset fund?
Right, and that's the other piece to that, which is that they run this portfolio two ways. This one they run with more leverage in it, so it tends to, and some of that leverage can be used to be a little bit more, have a little bit more leeway beyond, some of the fixed income instruments, including, they can even short if they want, and so. What we're suggesting, and so I think we would put this forth as a recommendation, is that in reclassifying it, which is just where it shows up in the report, we would also use the all asset portfolio as opposed to the all asset, all authority portfolio, just to tighten the reins a little bit in terms of what their underlying asset classes are.
Okay, so that's just, is that something we have to approve? Or is that just sort of an internal allocation?
I think it'd be best to approve it.
Okay. Fundamentally, I guess we're taking the risk level down a little bit, if I'm hearing you right, because of the lack of leverage. Just a little bit.
I think it takes the risk level, the range of from the standpoint of the range of outcomes, I think it takes it down a little bit as well.
Okay. And that's just you guys reallocating. So is the yield essentially the same? Is the duration essentially the same between the two funds?
It's the core of the two funds is the same. The all authority is a little bit more volatile in terms of answering that question, because it depends on whether they choose to
use their authority or not use their authority.
Use the greater authority on the leverage side. So there are going to be times where all asset, all authority has a higher yield than all asset does. But I've noticed over time that all asset tends to be, less volatile. So,
that's fine. Okay. Anyone else have any questions related to that?
Yeah, Ross, Paul Shea here. What's the level of leverage in that PIMCO?
It can go up. It can be 1.5 to 1 is.
Okay.
Yeah.
And what do you think it is now? Any idea?
It's if I can't answer it now, I can follow up.
Just roughly. It's less than 1.5 now.
I want to be sure.
Okay, that's fine.
Ross, Dennis Flagg.
Yeah,
I think you guys have done a spectacular job this year. And personally, I'm very pleased with your returns.
Thank you. Very kind of you to say that.
And I will concur with what Dennis said. I mean, and it shows why you need to diversify, because you don't want to take a bet on, value versus growth, or, long duration versus short duration on fixed income. And certainly I think the move we made several years ago to give managers some wider latitude, I think also is a good strategy, continues to be a good strategy.
Paid off.
In these worlds.
Russ, if you don't mind, you mentioned you're going to reclassify this PIMCO fund to alternatives. Does that raise any issues with, our investment policy, since we were talking about that, as far as, making sure we stay within certain ranges as far as the alternatives and so forth?
Yeah, I think on the margin we'll end up, it'll require us to do a little bit of rebalancing as we do that. But the way that we were thinking about it was that there's always a bit of a natural rebalancing that occurs, because we're paying out and we're paying funds out. So what that causes us to do is when there's money that's going out, it just enables us it helps us know where to take it from. And so that's really the way, because that's the way we do it. Because it's not you can see it's about a 3% position. So we'll end up nudging on the fixed income a little bit when we rebalance, or not nudging, I guess, in certain respects. And also keep in mind, by the way, one of the things, this Oaktree Strategic Income, it is, that's putting cash into the portfolio as well. So that's one of the areas. And we're also seeing it come, we're starting to get realizations that are coming out from the Blackstone portfolios. So we're seeing cash, starting to come in from those areas as well.
Okay.
Are we going to continue to look at that? Because obviously we've kept the illiquids, in that $8 million range. But if we're going to continue to return that, and I don't certainly mean for tonight, but are we looking at some other possibilities out there in the next couple meetings?
Well, yeah. So you can see this is I flipped over just to the IPS because it hasn't. This is, I know it's a new one, but it reflects the same. It reflects the same allocation. So there's a target of 5 with allowance up to 10, and with a bit of good fortune, it got up very quickly through appreciation.
Right.
So it caused us to kind of take the foot off the pedal a little bit in terms of adding money to illiquids. So we will we will continue to try and recycle into something, but it has to be attractive. Market things are very expensive right now. There's just a tremendous amount of money out there, sloshing around, and illiquids seem to be a place where people want to commit. One of the issues in illiquids is that there's so much money not only looking to get into it, but that's already committed and hasn't even been invested. That it is, it's bid up prices, and so all things equal, I mean, it's not that we don't want to time it for sure. But all things equal, public market investments are superior to illiquids if the illiquidity, if that extra premium for investing in illiquids isn't there, and we just don't see anything that's compelling enough right now. In fact, we've kind of, I know looks like a little lever here, but you can even see these are kind of our more tactical-ish views that. We've been sort of de-emphasizing new commitments to private equity.
Okay. Anybody else?
No.
Good news.
Okay.
I think this is the highest I recall seeing our market values in a long time.
No, I mean, you right. You add
84 million pounds.
You had 10% for the year, so in a tough year with such a disparity of returns, and so okay. Anybody else have anything for the good of the order as far as that investment piece?
No.
Nope. Good.
Okay, and just for your information, if anyone's had a chance to see it, we have our traditional pension disbursements and summary of bills in the package. That's just what we always have. And there was nothing, it doesn't look like, Jim, there were any new additions or deletions to the rolls this time. That's the other sheet that usually
Additions
give
to
us.
deletions to
Retirees. That's usually part of that info package, but it's fine. We have pension disbursements in the summary of bills. Sometimes there's a piece that shows someone might have died, someone might have,
yeah, there is 6B in the packet.
It's in there.
Okay.
Yeah, there is a person deceased.
Oh, I did not see that page. Okay.
Yeah.
Well, I will look for that.
I think
Okay.
it's really if anybody has any questions, but, you know, I don't see a need to put any of that, you know, on a screen share or anything like that, but let me know.
No,
No,
no.
that's fine. No, that's fine.
That's good.
Okay. Okay, so our next scheduled meeting is, it'll be that first week of May. So that is, bear with me.
May 5th.
Yes,
May
May
5th.
5th.
Cinco de Mayo.
Cinco de Mayo, okay.
Mike Evans is buying.
Yeah, I'm buying. Hopefully we're back alive. We'll see how the world is.
Hope so.
You know, be nice to, it's nice seeing everyone's faces. I'm just I'm not a Zoomer. I like seeing people. So anyways, but anyone else have anything for the good of the order?
Nope.
Make this short and sweet.
Michael, do you have to just officially, and if I didn't hear it, I apologize, but approve the PIMCO?
Oh, I'm sorry. That's my bad. Yes. So I'm going to make a motion to take the PIMCO all authority fund that, you know, I can't do anything in just one word. That had approximately $2.4 million as of December 31st to move that both to the PIMCO all asset fund and to reclassify it from fixed income into the alternative space. Is there a second?
I'll second it.
Okay, all those in favor?
Aye.
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 Thanks for reminding me of that, Ross. Okay. Well, then I make a motion to adjourn for the evening. Is there a second?
Second.
Second.
Second.